everybody. What are we going to do today? As I told you, we're going to start with individual taxation. And I will also, it's easy. You can just Google and you can say IRS Form 1040 download. The year that is going to be applicable for us is 2023. So this is how we are going to test. So this entire year, IRS or AICPA is going to test us for Form 2023. It's not a bad idea to have this master form print out with you and or follow it up in a soft copy. But every time we finish a particular area, we should be getting an idea of, okay, what portion of the form have we done? Okay. So tomorrow I'll take you through the form, the entire gamut of individual taxation. Today, I'm going to talk or restrict myself to one particular area, which is this box, okay, which is the filing status box. Okay. Which is this box. Okay. So this is the box that we are going to concern ourselves with now. Okay. So what are we going to talk about? We're going to talk about something which is called the filing status. Okay. So if you look at this is an individual, this is an individual taxation form. Okay. For US, and this is a federal tax form. What's a federal tax form? Federal tax form means, see, in India, we have the concept of center and state. So there's a central government and then you have the state government. There are certain taxes that is levied by the center. There are certain taxes that are levied by the state. So we have the state octroi and state taxes. Similarly, in the US, we have these concept of states which have far more or greater autonomy than we have it in India. So these states, so as far as CPA is concerned, every state has its own set of structure. Every state had its own requirement for what should be the eligibility and the licensing and the CPA requirements for the CPAs. But right now, what we are doing is this federal. That means so in India, which is equal to central. So federal means which is applicable throughout the US. So you have one tax, which is called the individual taxation. So if you're an individual working in the US, so this is something that's going to go a little bit, beyond what's there in your curriculum. But I think that's a very good starting point. So I'm going to take you through that. So this is an individual income tax form. So if you're earning an income, where we are going to talk about it. Then in the US, in the federal form, every year you'll have to fill up this form 1040 and you will have to pay your taxes. Just as in India, the tax is a self-assessed tax. That means we have laid down, so US government, the IRS, the Internal Revenue Service, they have laid down the entire rules and regulations that are applicable. We have also laid down a set of TRPs or tax return preparers or tax practitioners. So they've come up with courses like enrolled agents course, the CPA course, and they have put down a professional body whereby you can clear your exams, get equipped to deal with these forms. So if you are an individual who do not have any idea of how these forms work, we have laid down the method by which you can contact a professional and that person can help you file your returns. But at the end of the day, the primary responsibility becomes that of the taxpayer, which is people like you and me. As CPA, so there are only 3 categories of people who can qualify to have people write up their returns and also represent them. That means in case if let's say the IRS comes up and say that no, this tax is wrong and this is incorrect and you have to pay more, then these are the people who can represent the client, just like lawyers do it, right? So there are 3 kinds of people in the US. One is CPA. Once you get your license, that's a state license, but that can help you row and write your papers and then represent your client and help them file their tax returns. Second are enrolled agents. That's a federal degree. Okay. So if you are an enrolled agent who has a license, then you can also go and practice, help people file their return and represent themselves in the US. And the third category are attorneys. Okay, so you are one of them now. You are studying to be a CPA, and once you get your license, you become somebody termed as tax practitioners. In case if you want to go and choose taxation as a practice. Okay, so this is the form. These are the initial stuff which talks about your first name, middle name, last name. Now, see, this is important. You have social security number. We call them SSN number. So just like we have this unique identification number if you're an Indian national, similarly in the US, there is a unique number that you're identified with if you are a US citizen. That number is called the US Social Security number. Uh, Okay, we're going to talk about why is the spouse's name and why is the spouse details important if you're filling up your form. So when you're doing this form, so over the next, I think 10 sessions that we are going to use to cover individual taxation, when you're doing this form, I want you to put yourself into the picture. So if you are earning in the US, how, and if you want to file your income tax return, let's say without anybody's help, and would you be able to decode what is there? Okay. So you have your details and yeah. And then the first thing that we're going to talk about is the filing status. Okay. So now see, this is not a part of your syllabus. Okay. But somehow I feel it's a very strange thing. So when I was studying and then I did not find it in the syllabus, I found it a little uncomfortable because who is supposed to file the US tax form? That's the first question that comes to the mind, right? Why should I be filing this form? Am I liable to file this form? If yes, what is the periphery of tax that I'm thinking about? Is it only the income that I'm earning in the US? If I'm in the US but I do not have an SSN number, am I still supposed to file this? If I'm a green card holder, I'm supposed to file this. If yes, shall I disclose my Indian earned income there? So this, even though it's not a part of your syllabus, for just for information purposes, I think it's a very important starting point to know which person or who is the person who's liable to be paying tax in the US and in what income. Is it the worldwide? So there are two concepts. We call them worldwide income. So typically, these are people who identify themselves with the US fraternity. So either you become a US citizen, or you have a green card, or you are a resident alien. So we're going to talk about these concepts, even though they're not going to be tested. But this puts to rest and it gives you a very good idea of whether you should be filing up a Form 1040. And if yes, on what income are you going to pay tax? Okay, on the slide, I've clearly written just for information. But I think without this data, there's like a question mark. Because for me, at least when I was studying, I found it very difficult to start without knowing the periphery or the outer periphery. So we are going to first talk about this. Then I'm going to talk about the filing requirements. So first, we're going to study if I am eligible and on what income I'm supposed to be paying tax. That means Form 1040, am I supposed to fill up? If yes, what portion of income I'm supposed to show there? Then we're going to talk about, okay, now I know I should be filling up a form. But this particular year, should I fill it up? Did I earn enough? So let's say you just got married, you moved to the States, you're not working, your spouse is working, and you have no idea whether you're supposed to fill up this form or not. Okay, I just conducted some one or two webinars and I had some income, but was that income big enough for me to go and file my income tax return for that particular year? So here we're going to talk about in a particular year, financial year. So US has financial year, guys. Okay. Mostly when I talk about an income tax return, I'm going to talk about 1st of January to 31st of December as my tax year. And then we're going to talk about, okay, this is the time period during which I need to be considering my income. But when is the due date? So we're going to talk about the due date. So by what time shall I fill up Form 1040? And if I don't fill it up, what are the problems? So the penalties we're going to talk about later when we're going to talk about the federal procedures. But today we're going to talk about the individual. So this entire session over the next 10 days, we are totally going to concern ourselves only with individual taxation, which is Form 1040. Okay. Now, after these, we're going to definitely talk about the filing status. Now, see, in India, we have only one status for individuals, right? So, if I'm a person, I am one, I have this only one status, right? I could be a partnership, I could be a Hindu undivided family, I could be an individual. But as an individual, there is only one status in India. But in the US, as an individual, there are 5 different statuses. Why and what is the root behind it? We are going to talk about it, but we are going to talk about those 5 statuses. Okay. Now, out of these 5 status, you would see that when I look at the tax slabs, Now, just like in India, we have this step system of taxation, right? So if I'm earning 5 lakhs, I will not pay tax, or let's say 15 lakhs is if it's that's my earning, I will not pay a flat rate on 15 years. There's a graded rate structure. Till this nil, then this to this a particular rate, this to this a particular rate. Same concept is in the US. But depending on what is your filing status, some status will give you an economic tax saving, and some of the statuses they are trying to ensure that they're so bad as far as economics is concerned that they're discouraging people to use that status. Okay, so we are going to talk about what are the status. So there are 5 status, but if you look at it, there are 3 tax slab rates. Okay, so basically, there are 3 different tax slabs which can be applicable for people who can file under 5 statuses. So even as an individual, you have 5 different categories, and each of these categories will lead you to a different tax regime. And out of these 5, there are 3 tax. So I'm going to show you this slide because that gives you a perspective about what is the economic saving. See, we are talking about the tax rate. The high, anybody, any idea what is the highest tax rate in the US for individual taxation? Any idea? What is the highest tax slab? So if I talk about the marginal tax rates, what is the marginal tax rate? The highest marginal tax rate for individual taxation in the US. Any idea, guys? Just take a guess. Write in the chat panel. Take a guess. Write in the chat panel. Yes. So yeah, it's 37%, not 40. 45 is, who's this who wrote 45? Siddharth, 45 would be after you considering the state taxes. Right now, we are not talking about the state taxes. This is just the individual tax, which is a federal tax. Yes. So 45 is still on the, but yeah, around 40 to 45 is an average if you consider all the state taxes as well. But right now, we are only talking about federal tax. Jaishankar, 25% is incorrect. 21% is for the corporates in the US, but 37 is the highest tax slab. Yes, Siddharth. 37 is the highest published federal tax regime in the US. So that's a lot of money, right? That's a lot. That's the reason why the state schooling is free. So we have a different now. There's a big wave coming in India where we say that, see, we don't get so many benefits from the government. Our hospitals are not that great. Our public schools are not that great. Why should we be paying so much of tax? But 37 is a lot of money, right? You earn 100 rupees and you pocket only 43 rupees. So on an average, if you include everything, it is definitely 40%. That's a big amount, right? So there, if state gives you an economic incentive that if you choose this rate, this particular status, I'll give you a tax concession. That's a big amount which cannot be ignored. So we're going to talk about the filing status. Then we're going to talk about this concept of dependence. Now see, 2018, Donald Trump government came into power in the US, and this government came with the promise that a lot of immigrants had come into the US, and his political pitch was that we are going to strengthen the American community, and we are going to stop the immigrants from taking over the jobs of US guys. So what he did, so now see what used to happen in America. Now America has, you have to understand a little bit of history of America to understand the tax regime. Unlike most other nations who have the natives, like we have some native Indians, we have native Europeans, native, you know, uh, Americans, Australians. America is actually a melting pot of a lot of communities who came and who overthrew the people who were actually staying there. So the Red Indians, who were the actual natives of America, they are still not, they don't have that status that you have if you are owning a particular place. So America was a melting pot of lot of communities who came and found prosperity there, right? So before the Donald Trump government, what used to happen was this: they used to say that if there are people coming and staying with you, and if you are providing for them, every count that you are having. So let's say I go and settle in the US. Then I bring my sister, then I bring my brother. They go and have their children, but all of them are staying in my house. So earlier, before 2018, we used to have this concept that the number of dependents who are staying with me, if I can substantiate that I'm providing for them, then on every head I would count, and there was a big chunk of money that I would get as a tax reduction. Now that used to be called as something called personal exemption. And we have taught that in the sessions prior to 2018. So, right, I started teaching in the year 2012, 13. Since then, I think the major overhaul that came was a Tax Cut and Jobs Act. Apart from that, there has not been such Herculean changes in the tax system in the US. So, we used to call that amount of tax deduction as personal exemption. But then the Donald Trump government came and they said, no, I am not, because this is giving you an economic incentive to have more people who are going to be dependent on you. So he did away with personal exemption. There was this concept of something called standard deduction, which was like a flat amount depending on your age. So for everybody, I take a standard amount and I say, see, you will have to spend this amount of money to maintain yourself. So for that amount, I give you a standard deduction. My son uses this term a lot. In English, Mama, I'm not going to get full marks because there's a standard deduction of 2 marks in English. So everybody will get that deduction, right? Similarly, in the US, if you're filing up your individual income tax return, there's a standard amount that everybody across various categories gets as a deduction. Now, what the Tax Cut and Jobs Act did, it increased the standard deduction across for everybody, and it did away with this concept of personal exemption. That means counting the number of heads who are dependent on you and getting an economic incentive out of that was totally done away with. But then the question comes, why do we still have the concept of dependence? Why are we studying about it now? Why? Two things. First, there are certain statuses that depends on the dependents, right? So there is a head of household status for which you need to know whether the person who's staying with you is your dependent or not. Plus, there are 2, 3 major credits that depends on the concept of dependence. So we have retained the concept of dependence, but not for claiming personal exemption, but for availing of certain other tax benefits that we're going to talk about. Okay. And again, this is a concept out of all of these topics. There are 2 concepts which I don't think are, this is still a part of your syllabus a bit, but I don't see a lot of practical questions coming from here. But this is an important concept. There's something called kiddie tax in the US. Okay, what's a kiddie tax? Let's see, in India, we have this concept of set off, right? So if, let's say, parents are earning a lot, I have 4 children, and then what I do, I take some part of my amount and then I create fixed deposits in the name of my children. Why? Because I think that, see, these people will not have any tax on them because their earnings will be very less. They're below the age bracket of 18 years. So that amount of money that I would have taxed at a very high marginal tax rate of, let's say, 37%, I will not pay tax on it. So there is this concept where they say that if you are a child below 18 years of age, and if your parents, and you have a lot of unearned income means passive income, right? You have interest, you have dividend. If all of these income is coming to you, if it is beyond a particular threshold, I am going to tax it in the name of the dependent. So let's say I have a son who's 12 years. So what will I do? I will take my money and I'll put an FD in his name. But then what the government will do is say, okay, there was an FD, the amount of interest was hefty. So what will I do? I will make that kid file an income tax return, but the tax that kid has to pay would be equal to the parent's higher marginal tax rate. So assuming that money is actually mine as a parent, what is my highest tax slab? Let's say my tax bracket is 37%. I will make a kid's file a return and pay tax at the rate of 37%. That's called the kiddie tax. Again, this is only for information. I've written it on the slide. But when I was studying, I found this info because, see, in India, we start with residential status. If you remember, every time when we talk about tax, we first start about resident and not ordinarily resident and stuff, right? Because that fixes you. Okay, you are supposed to be paying tax in India. But we didn't have any such thing in the CPA. So I was like, what are we doing? So we could not start, right? So that's the reason I want to give you this start. Now, first thing is, if either you are a US citizen, if you are a US citizen, then obviously you are not an alien to the US. So now think, so every time when I teach you a provision, I will consider myself to be a part of IRS. So I will keep on shifting my stance, IRS, taxpayer, IRS, taxpayer. So every time you study a law, Study it from the perspective of the IRS. As a US government, why do you think this law was important? If you can understand that, then you've understood then how is easy, guys, right? The why is more important. If you understand the why do we have this? Then the how is really simple. You can just study yourself and you can educate yourself also. So if you're a US citizen, point closed, you get your social security number and you start paying tax in the US. If you are not a US citizen, then you need to know whether you have a green card or not. Now, having a green card does not give you a citizenship status in the US. It does give you an idea that yes, you have been in the US, and yes, there is an immigrant, so you're a legal immigrant in the US. And subsequently, you will get a US citizenship if you don't mess it up in a big way, right? So, either if you have a US citizenship, then in that case, you're treated as a US citizen, you get your SSN number, pay taxes. If you are not a US citizen, then first thing you need to ask yourself is, do you have a green card? If you have a green card, then technically for the IRS, you become a resident alien. Alien means somebody who's not a US citizen. So you're not a part of a family. Think of US as a family. Either you're born in the US, you become part of my family. I am not born in the US, but I got married and I'm staying with you for such a long time that I'm practically a family. So what I'm doing, I'm giving you a lead time because you're not divorcing, right? If you're not divorcing and if you're there with me for a long time, that gives you an opportunity to become a part of my family. But till the time I don't formally include you as my family, I will say you're an alien, but you're staying with us. So you become a resident alien. If you do not have a green card, and if you are not a US citizen, then the IRS will ask you, have you been with us for a long time, at least for this particular tax year? That means, am I having a feeling that there is a possibility that you're thinking of making us a part of your family? In that case, I will talk about something called substantial presence test. So just like in India, we have this resident and ordinarily resident category. In the US, if you are there in the US for any particular year for 31 days, and I go back 3 years, current year, 1 year back, and the current year, last year, and the year before that. And I will give you a weightage. Like, current year, 1 day is 1 day. Last year, I will put it 1/3. So if you have stayed for 3 days, I will count it as 1 day. And the year before that, I will take 6 days and I will count it as 1 day. Okay, this is not a part of your syllabus, but I wanted to explain you this. So I'm not going to get into technical questions here, but understand which income are you going to be taxed on and who is the person who's going to file a Form 1040. Okay, so US citizen, SSN. Resident alien, that means a green card holder, you get another number called the individual tax identification number. You pay taxes. If you do not have a green card, then I'm going to ask you, were you with us for a really long time in the current year, in the past 2 years? If yes, then also I'm going to put you in the same category of resident alien. So these are all of those people who got married. So, think of it like, I don't know, if you're fond of Godfather, like, everybody in my family is a big fan of Godfather. Think of yourself as a Godfather family. Okay, somebody is coming and getting married in my family. We have a very rigid system of knowing whether we open the doors for you or not formally. So till that time, I'm going to test you. And in that testing time, so these are the people who are just newlywed to your family. These are probably in the stage of being wedded. And these are the people who I have cleared the first step. That now another step, if you don't goof up, will make you a part of our family. That becomes the green card test. So in your mind, you should be able to register the keywords citizen and you should be able to register the keyword resident alien. If you are neither you have a US citizenship, nor you have a green card, nor were you present in the US for a substantially long period of time, considering this year and the last 2 years, then I'm going to ask yourself, is this the first year that you are in the US, or is it a short year in which you're leaving the US? Okay, because let's assume you just got married and you moved to the US. Your spouse was already there in the US working, earning. And now you have an option of either joining with your spouse. So we know that in the US, there is this option of filing jointly. So as couples, you can file jointly and you can submit your income tax return. So let's say you get married and your spouse is already working and both of them are now jointly filing a return. So your spouse may be a green card holder or a US citizen or a resident alien because of the substantial presence test, but you aren't. But you get an option. Okay. So what I ask you is, let's say so this was the year in which you just moved to the US and you started working. You don't qualify for the substantial presence test. Obviously, green card and citizenship is out of concern. You become a dual status alien. So you have a choice that you can think that for part of the year you become an Indian citizen, for part of the year, or you file your returns in India. Part of the year you can become an alien filing the return in the US. Why? Because you worked and you earned in the US. But if none of that applies, you are typically a non-resident alien. And for any reason, if you have to file up a return in the US, you need to get something called individual tax identification number to submit your return. Now the question is, why would I be filing any return? I am not in the US. So physically, I'm not in the US. I'm not doing anything in the US. Why? Because I'm earning in the US. And the US government is very clear. If you are earning in my soil, on my soil, you will have to pay a portion of that earning to me. So every time somebody is a non-resident alien. So who's a non-resident alien? Somebody who is not qualifying for the substantive presence test, green card test, or a US citizenship. If you are a non-resident alien, generally you're supposed to just pay tax on the income that you earn in the US. Okay? But the example that I gave you, I got married, moved to the US, my spouse was already there. Now we choose to go and file a married filing jointly return. So in that year, I'm a non-resident alien, but for the purpose of filing a joint return, I can choose to be treated as a US resident. That's the only criteria whereby a spouse moving to the US, filing a joint return with somebody who's already there in the US and qualifies to file a joint return, can choose to file themselves as residents rather than non-resident aliens. Okay? And remember, if you are a US citizen or a resident alien, you get to get tax on the entire worldwide income. So there are two categories. You call them US source income and worldwide income. So if I look at it at a very root conceptual base, if I identify you as a part of my family, wherever you are, so if I am a godfather and I'm a part of these Don Collierine family, then wherever you are smuggling and earning money, you go and get, you pay hafta to me. That's the kind of concept that we're talking about. Wherever you are earning, you pay tax to me in the US because we identify you as a part of our family. But if you are not a part of a family, only that part of the income that you're earning by virtue of having that earning from the US base, you have to pay tax on it. Okay? Green card holders, the term green card is typically giving you a lawful permanent immigrant status in the US. Okay? Dual status aliens are those people who can choose to be treated as US resident, not for the whole part of the year, but for some part of the year. Okay? Now, one thing I want you to understand is, irrespective of the fact whether you're filing for a US source income or the worldwide income, you would pay tax via what? You would pay tax via Form 1040. So remember, guys, tax is law, right? It's a law. So there's an Internal Revenue Code, IRC, which has defined you the Internal Revenue Code. So please remember, that's the reason why you have attorneys specializing in taxation law who would become tax practitioners. So this only understands the language of law. There is a law written which says if you want to submit your tax return in the US, either get an ITIN number and submit your tax return or on the US source income, or become a resident alien or a US citizen, get a social security number and file your income tax return. But in any case, the IRS should have your identity so that they can register and say, okay, this is the person who is filing the tax return. And they already explained you. So how do you get your substantive presence test? They'll tell you at least 31 days during the current year. That means 1 year, 1 month in the year, and 183 days during the last 3 years, in which the current year, 1 day will be 1 year. Last year, 3 days will be 1 year, and the year before that, 6 days will be 1 year. So if you follow, and if you are so something like physical presence test. Physically, if you're in the US for such a long time, I would still call you a resident alien, and you have to pay tax in the US. Okay, so this gives you a setting regarding when are you liable to pay tax in the US and what should be the income that you will offer for taxation. Is it the worldwide income or is the US source income? Now you get to who is supposed to file. So in this current year, I just moved in with my husband and I was there only for 2 months. I earned some, let's say, $380 in the US because of some ad hoc assignment that I did. Am I supposed to go and file my return in the US? If yes, what is the requirement? So, what is that minimum requirement that you need to abide by in order to file your returns in the US? So, see, Form 1040 has to be filed if what you're earning is more than that standard deduction that I'm about to give you. So every year there's a standard deduction. We're going to learn more about it. Now, these are indexed figures, guys. Every year these figures keep on changing. So every year there would be a standard deduction. If you are earning an amount which is higher than the standard deduction, you will have to pay tax on that amount. If you are not, working for somebody, but if you're working for yourself and earning money, the example that I gave you, I'm working in the US. I took some ad hoc classes in the US, and I earned income there. If that self-employment income crosses $400, then also I'm supposed to file 1040 and pay tax in the US. So please remember the tax may still be zero. Why? Because you will see that if your only income was your self-employment income, and if there are particular thresholds of taxation, you may not be required to pay tax. You might have the ultimate tax liability of zero. But, so see, can you understand that this tries to give you a feeling that there is a lot of culture of self-employment in the US because the IRS wants to keep you on track. The IRS makes it mandatory for you that if you're earning more than $400, you are a potential person who can bring in some decent amount of money in future, and I should keep tab on it. See, I've given you a norm, right? The standard deduction figure is a really high figure. Why would I want you to report and just file your income tax return? Let's say if I'm earning $500, how does it affect you? We want to keep track of you because I want to make sure that if you are earning 400 can become 40,000. See, understand that what's there in the US today. If you go to the US, let's say 40 or 50 years back, half of those companies did not exist, and now those companies are ruling the world, right? So if you are self-employed, and looking at you at a prospective bigger company, right? Look at LinkedIn. Go to Palo Alto right now, and you will see most of the, just stand on the crossroad, all of those companies, and then close your eyes and think 50 years back. They didn't exist, right? So self-employment income more than $400, you have to report it and you have to file Form 1040. Whether you pay tax or not, that is according to the law that I've given you. But I want you to file the form. One more thing is that last point that I told you, right? The clubbing of income, I don't want you to avoid. So if you are a dependent and if the amount of income that you're reporting exceeds the standard deduction, or you have an unearned income which exceeds $1,250, then also I would want you to file your income tax return. And this is actually related to the ED tax, because I am trying to figure out whether your parents have siphoned off their income in your name or not. So I want to prevent that leakage from the system. So three kinds of people who are earning more than the minimum amount of deduction I'm offering to them. People who I think have a potential of earning much more in the future. So if your earning from self-employment exceeds or equals $400, or if you're a dependent whose gross income is reasonably higher than my standard deduction, or you have an unearned income, because that gives me an idea that your parents might be siphoning off their money to you. Okay. Now, see, this is important. Think of all the child artists in the US, right? The Harry Potter, all of these, Emma Watson. Some point of time, these guys must be earning a lot. Think of all those child superheroes as far as sports are concerned, right? So all of these people might be making a lot of money just because they are dependent on you as a child. Does not mean that they will not pay tax. If they are earning more than the gross and the standard deduction, they will have to pay tax. Or if you feel that the passive income is a lot more than a particular threshold, which is 1250, then also I feel that I should ask them to file their income tax return. Okay. Okay. One thing you've got to be very clear. I don't like the married filing separately couples. Okay. I don't want people to be married and yet filing separate returns. Okay. Because in that case, potentially you're married, but at the same time, you're taking the benefit of paying lower taxes because you are taking married filing jointly and you're just dividing that rate by two. I don't want that. So so remember one thing, married filing separately is a compulsive option given by the IRS. They can't do away with this option, but they don't want to promote it. So later on, you will see as a filing status, married filings separately, I'm very, very cautious. I'll not give a lot of the benefits of taxation to these categories. And the moment I say if your gross income is even just more than $5, I want you to file your income tax return. Okay, I treat them separately. I treat them like, somebody I have to be very, very careful about. Okay, so remember for married filing separately, I'm very skeptical. So for them, I just want them to be on the radar anyway. Okay. So first we studied about who are the people and what kind of income they have to offer for taxation in the US. Then we spoke about under what situations in a particular year would the IRS make you liable, require you to file your Form 1040. What is the due date? Now, first, always understand that if you want to pay your taxes in the US for the income that you've generated, so remember, let's say I'm talking about 2023. So 2023, my period of earning income would be 1st of January to 31st of December. Entire last year went by. This year, I will give you another 3.5 months. So it is Jan, Feb, March, April. April 15, 2024. That's the end date for you within which you have to pay all your dues to the IRS. So remember, for paying taxes, there is only one day, which is April 15. But let's just say because of some unknown or unforeseen circumstances, you are not in a position to file your return. I'll say, okay, you just file up one form, which is form 4868. Now, see, generally, they don't give you the form numbers. They are not going to test you on the form numbers. Okay. Even if they want to give you a form, they will reproduce a section of 4868 and they'll tell you. So there is a possibility where the moment you file a form 4868, you automatically get an extension till 31st, till 15th of October. That means a 6 months extension. You get a 6 months extension, but so we call it an automatic extension. That means I don't have to wait for the IRS to accept it. The moment I file Form 4868, automatically I get a 6 months leeway or a 6 months extension to file my return. But please remember, only for filing, not for paying taxes. Okay, this is applicable only for filing, not for paying taxes. Yes, not without. See, Anirban, unmute yourself. Yes. So let's say I have filed all my taxes by April 15th. Okay, and I have
Yeah.
filed Form 4868. I will not have to pay any penalty for filing my return 6 months later. But if my tax was due, let's say when so think of it practically, okay? I have not filed the form. So I think whatever I've paid and whatever TDS has been deducted is okay. So I think everything is okay. I just filed Form 4868. But the day when I go to file my return, I see there was some underpaid tax liability. For that, you will have both the interest and the penalty. but not for filing the returns. Is it okay?
Got it. Yeah.
Yeah. So for filing any amount of tax, if that is underpaid, you will get penalty along with interest. But for filing the return, no, no penalty, no interest. So late file, there's something called late filing penalty. That will not be leviable if you would have filed Form 4868. Why is it called an automatic extension? Because you don't have to depend on the IRS to approve you for getting that extension. But then, is it not if I don't file a form on April 15, automatically it gets extended? The answer is no. If form 4868 has not been reproduced to the IRS, they will not give you an automatic 6 months extension. Is this clear? Anybody any questions? This is like a simple thing, and even if they test you on this, it will be some MCQs. Okay? So if you have not filed from 4868, then you were supposed to file your tax return by April 15, failing which you will have a late filing penalty. But if you have filed from 4868, your due date is October 15th. Okay. Now we can talk about the filing status. Okay, so if you look at the form, right, this is the form that I spoke about, right? So if you look at the form, can you see there is 1, 2, 3, 4, and 5. There are 5 filing statuses in the US. So even as a person, you can choose 5 different statuses. Okay. So there is an economic incentive for getting married and remaining married in the US, guys. Okay. So the community, I don't know. I want to do this. Let's see if I'm able to crack some. So there were 1 or 2 good podcasts that I heard in this category. One was a lady who's a black lady, and then she discovered how the black community, if they're filing as married, filing jointly, it's not helping them. The end, they are ending up paying a higher tax than the white counterparts. And that was like an eye opener. And she came up with a lot of books, and then there have been some changes in the laws post her comments, right? So if you look at the tax slabs, guys, right? If you look at the tax slabs, you will see that there are 3 tax slabs. One is for single, one is for married filing jointly, and one is for head of household. Now, qualifying surviving spouse, which earlier they used to call it qualifying widower, okay? But now, America to a great extent has become a gender neutral. At least they're trying to aim to become a gender neutral society. So they have replaced the word widower, which had a very strong male connotation, to the word qualifying surviving spouse. So this is actually a kind of a tax relief I'm trying to give somebody whose spouse died. So typically what they're trying to tell you is just imagine a person who had a spouse. Spouse died. In the year of death, I will let you file as married filing jointly. Because had the death not happened, you would have still gone ahead and filed a married filing jointly return. But 2 years subsequent to the date of death, if you are having a dependent child whom you are supporting, then I am going to give you the advantage of the tax slabs of married filing jointly. So remember, in the year of death, you file as married filing jointly. But 2 years subsequent to that, if you have a dependent child whom you are maintaining, I let you take the advantages of lower tax incidence as married filing jointly. But I want you to qualify yourself as qualifying surviving spouse. So I would know, okay, this is the leeway given to you for 2 more years. And within those 2 more years, I expect that you will plan your life so that the change in tax status from a qualifying surviving spouse to either head of household or single would not be very difficult for you. So if you look at the tax slab, guys, okay, wait, I'll show you the tax slab first. See, this is 2023 tax slab. If you look at the tax slabs in the US, you have only 3 tax slabs. You have for single. If you look at it, you will get the highest incidence of tax here. How? See, the 10% tax slab is applicable only till 11,000. That means this is the earliest, this is the category where you will hit the highest tax slab rates the, the soonest. Can you see this? The soonest. Married filing jointly is the best or the most economical. Why? Because it will it will lead you to pay the minimum taxes. Why? See, the tax rate hits 37%, but only at the amount of your earning crossing $693,000. Right? And also, if you look at it, you get a greater advantage. So, if you compare the ESOC guide, there is something called effective tax rate, and then there is something called marginal tax rate. I'm going to discuss these concepts together. So first, remember, it's a single day test. 31st December, when the clock strikes 12, were you legally married or not? If yes, you would get the opportunity to file as married filing jointly. Okay? So it's a single day test. Are you legally married? If yes, whether you're staying together and you're alive for the whole. Okay, why is it important? I know this sounds very ridiculous right now, but it will all fall into place by the time I'm closing this entire slide. See, what I tell you is, if you are legally married, okay, and staying together, so this is like a plain vanilla normal scenario. Two people married, staying together, and none of them have lost their lives during the year. So the example that Siddharth just gave us, there are two people moved to the US. So there was I'm talking about, I think 15, 16 years back, Hyderabad. I had a colleague who was in Hyderabad then, and they had a mergers and acquisitions department, and they wrapped up that department. And at that point of time, whoever was working with them, they gave them an option to shift either to Gurgaon or to US. So there were two options given to them. And we met a couple who had just got married and they chose to move to the US. Okay. So imagine a scenario like this. You just got married and then you shift to the US and both of them are still working in Deloitte in mergers and acquisitions department. Are they legally married? Yes. Are they staying together? Yes. Hopefully none of them die during the entire year. So in the ideal scenario, both of the people are living and are staying together and they have a marriage contract that they can prove. They get to file a married filing jointly return and they choose that status MFJ, which gives them the benefits of lower tax rates in the US. If you are not legally married, okay, so if you do not have a paperwork to show that you're legally married, you're just living together with somebody, does not give you the option of filing as married filing jointly. So if you're not legally married, you get a single status. If you are legally married, so there is a marriage contract which is still valid, but you are legally separated. So you got married and then you executed a divorce agreement. In that case also, the moment the divorce decree becomes final, both of these spouses go and file as single, unless and until they remarry with somebody else, right? So if you're legally married, then you're not staying together and you are legally so. If you're legally married, living together, you get a joint return. If you're not legally married, you file as single. You're legally married, but after that you got legally separated. There's a divorce decree that is final. You file yourself as a single individual. You are legally married, not staying together, but the divorce decree has not become final. So you are just separated, but you are not legally separated. So physically you're staying apart, but there is no divorce agreement between the two of you. You can still choose to file a married filing jointly couple. Two people were married, okay? Two people were married, A and B. Unfortunately, B died in the road accident during the year. Can A still go and file a married filing jointly return? The answer is yes. Irrespective of the fact whether a spouse is married or whether the spouse is living or dead, in the year of death, the surviving spouse can go and file a married filing jointly return. In other words, the one thing I want you to just write it somewhere in your book or whatever you're following, birth and death are not prorated in the US. Okay? So it will never be that, let's say, 31st of March, one spouse died. It will not be that from Jan, Feb, March, you will file a married filing jointly return. Then from April to December, you will have a single status. No. Had that death not happened, would you go and still file a married filing jointly return? If yes, you would still go and file a married filing jointly return. So remember, every time there's an answer choice that asks you in the year of death, qualifying surviving spouse, the answer is no. In the year of death, married filing jointly. 2 years after the year of death, it will be qualifying surviving spouse. Is that clear, everybody? So if you're married, staying or not staying together, alive or dead, one of them, you still get to file a joint return. The only time you don't get the benefit of joint return is either when you don't have a legally executed divorce decree or a legally executed marriage contract. Only in these two scenarios you will be filing as a single individual. Is this clear? Anybody, any questions? Okay. Two things here I want you to say. But first is that every time we have a marriage filing jointly, so in the US, there is a recognition of same sex marriages that has a legal recognition. In India, we're still fighting for it. We're still, I think, we're coming closer, but it's still going to take a lot of time, right? But in the US, they're going to call same sex marriage as a legally married couple in the US. So you can file a marriage filing jointly couple legally. Both parties are jointly and severally liable. Now, see here, again, this is not a part of your syllabus, but see, there is this concept of injured spouse. Okay, and there's this concept of innocent spouse in the US. Now, see, the best part is no two Jamela filing your return, right? Today, my husband is working somewhere else. I'm having my own business. I have two separate returns to take care of. In the US, they can just go and file one return. So that's a good thing. And you get an economic incentive. That's the bonus. But what's the flip side? See, if one person is wrong, right? If one person has a history that you're not aware of, you got married, chances are that you are also stuck. Okay, so imagine a guy who had a wrong, bad history of not paying uh, there's a very good movie, it's slipping my mind. It's about Will Smith and how he camouflages himself as an IRS consultant. His wife and his child died, and now he's passing through his acute depression and he's decided to end his life. But before that, he wants to do good for at least five people. And how he determines who are the five people whom he has to do good, he does it via the IRS record. What is the name of? Let me look at the name of that movie. I'll give you the name of that movie. If it's possible, please watch that movie. It's a good movie, right? By the way, uh, it's something with C if I'm not wrong, but I'll give you the name of that movie. Okay. So what's the flip side? What's the name of that movie? No, 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 not Seven Pounds Moses. It's another movie. Uh, Maybe 7 pounds. I'm not too sure. I'll check and let you know. If, maybe I'm not too clear. I'm not aware of the name right now. But yeah, that's a very good movie. That also gives you the idea of how powerful IRS is. Okay, by the way. Okay. So the problem is you get married to somebody who does not have a good IRS history. You really fucked up, right? Why? Because now you become jointly liable to pay this guy's taxes also, right? So be very careful when you're marrying. That's the important thing. People say that you get your blood reports when you're married. There's this I don't know what's going to happen in the AI thing, but yeah, it's a very important thing to check somebody's IRS history before you get married, because the moment you put your name attached to somebody else's name, then you become jointly and severally liable for paying the federal taxes for both of you, which means all that past history becomes your baggage also, right? So there you have such provisions for an injured spouse and an innocent spouse, whereby you don't want to pay somebody else's taxes. Okay, this is not a part of your syllabus, but you need to know that this is the danger of filing a married filing jointly return with somebody as well. Okay. Now, see, married filing separately is, again, as I told you, IRS definitely doesn't want you to file a married filing separately return. Why? Because you're enjoying the benefits of half the rate because it's lower than your single. But see, the only reason why people may not want to file jointly is, let's say, if I don't want my spouse's name to be attached to mine, or maybe that now you are a tax expert, you know so many provisions of tax. You get married to somebody who's born and brought up in the US, or probably moved to the US 10 years before you. You want to be very skeptical. So for the first 2, 3, 4 years till the time, I mean, I am not promoting bad ideas, guys. Please, especially those of you who married and you have a spouse staying in the US, But there is a possibility that for the first 2, 3 years you file as married filing separately. You get to know that person really well. Then you go and file a married filing jointly. I'm not saying people do that, but the reason why they may be doing it is because then you are off. You don't get to be jointly and severally liable for his or her liabilities. Okay. Now, can I file a married filing separately even if I'm not working? I don't have a work visa in the US. Can I still go ahead and file a married filing separately? Answer is yes. Even if one spouse is not working, or even if only one spouse has income, you can still go ahead and file a married filing separately return. Now, there's something called a separate property state and a community property state. Okay. Now, that depends. Different state has different statuses in the US. If you have a community property state, then whatever income is being earned jointly by the couple, it will be split 50-50 in both. And both of them have to file 50-50 of return, deduction, credits, everything. But in a separate property state, you get to book your income, your credits, your deduction. He or she gets to book their income, their deduction, their credits. Okay. But why is IRS so? Why does IRS does not want it? So IRS does not want anybody to file a married filing separately coupled. So what they do in order to discourage it, they will pull back certain advantages. Okay. The first biggest problem with married filing separately is if one spouse is used. So this is like a little premature to talk about right now, but later on you will see that there are certain deductions called itemized deduction, and there's a choice that either you can itemize or you can standardize. You will see that if you're filing as married filing separately, even though you're separate, you're connected with a cord, right? Which means if you're going in one direction, the other person also has to go in the same direction. They can't choose like this. Okay, you can't take the best of both the worlds. So we'll talk about it again when we're doing the itemized deduction in the standard deduction area. There are certain credits. Now, this is earned income credit is called a pathetic credit in the US. You're so poor that the state is giving you money to stay in the US, right? Then there's something called child dependent care credit, education credit. These are the expenses that will not be, these are the credits that I will not give you if you are filing a married filing separately return. That's the reason, this is the way that IRS discourages you to go and file a married filing separately return. Okay. So what about qualifying surviving spouse? So see, the moment you hear qualifying surviving spouse, the first thing that should hit you is not in the year of death. Not in the year of death. In the year of death, it will be married filing jointly. 2 years subsequently, you may choose the status of qualifying surviving spouse. What are the conditions? First is that you should not have remarried, right? You should be single. So you may be a qualifying surviving spouse, but you can get this status only if you have a child who is dependent on you. Both the conditions have to be met. There was a spouse who died last year, and you have a child to support. So remember, guys, in the year of death, it is only your married filing jointly. But it is 2 years subsequently that you can use joint tax return rates. That means the rates that you use of married filing jointly rates. Even the standard deduction that you use will be married filing jointly standard deduction. So you get the advantage of paying lower taxes and the status becomes a qualifying surviving spouse. So what is when? So we know this now. This is clear. This means last year the spouse must have died. The spouse must have died, and at the same time, no remarriage. M-A-R-R-I-A. No remarriage. Okay, guys, two things. Last year, the spouse must have died, or the year before that. So last year or year before last year. Because you have two chances to call yourself as qualifying surviving spouse. Either last year or the year before that. The death of a spouse must have happened and you would not have remarried. If that happens, that's the first criteria which is already being met. So this is the criteria 1. What's the second criteria? You must have a dependent child. So the question is who is dependent and who's a child? How do you define dependent? How do you define child? See, when you say a dependent child, it means you must maintain principal place of residence for the whole year for the dependent child. Now, see, the definition of child is a little open in the US. Child would mean your, so it's like, your lineage up and down. So, child would mean your sons, your brother, your sister, their sons. All of that will be a part of the definition of child. Okay, so typically in the exam, you will not see they making a bigger fuss about the definition of child. They'll tell you qualifying child. They'll not give you a scenario where you will have to define child. But remember, so when you say principal place of maintenance, and what do you mean by maintenance? We're going to talk about it. So typically it means is you are a qualifying surviving spouse and you had a child whose home address was given as your address, and you were paying for the upkeep of that house for the whole year. Okay. Remember, the child would include your child who's dependent. That means you are paying for the support of that child, your adopted child, and your stepchild as well. But it will not include a foster child. See, foster children in the US is a concept, guys, where the state will put certain children under your care, and that care becomes formal care, right? Again, I don't know, I forget the names of all the movies, guys. There's a very good movie about Sandra Bullock, and that's a real movie, guys. And there's this big black guy whom she has formally taken as her foster child. What is the name again? I'm forgetting the name of that movie. I'll give you the name of that movie when it comes. It's a very good movie. Blindside, yes, Ritika, Blindside. That's a very good movie. That movie explains you what is the concept of a foster child, right? So basically, you take somebody in with you as a foster child. So here you will not be able to claim a qualifying surviving spouse status if you have a foster child. Okay, so when do you get a QSS status? You get a QSS status well for the whole year. Remember, it must not be a part of the year. For the whole year, the child. So when I say, what if the child is gone for a high school? What if the child would have gone and staying in a hostel? Can I still say the child is my child and I get a QSS status? The answer is yes. If you're paying for the child's tuition and if your house is the designated residential address for the child for the entire year, you will still get to claim the child as your dependent child. Okay? And when do you get an HOH status? Now remember, if you are an HOH, a head of household status, it means you're not a QSS. That's number one. You should not be a qualifying surviving spouse because obviously you get a better rate when you get a QSS. Why would you go for an HOH then? And second, now this is something that's very important. A non-resident alien cannot have a head of household status. This is a privilege that is given only to people who are either resident aliens or US citizens, not otherwise. Okay? A non-resident alien. So, see, these terms are very difficult to explain if I don't give you the first slide, right? So, even though they have not taken the concept of the first slide as a part of your syllabus, but I think it's very important to explain the other concepts. Okay? So three things, either you're single or you're divorced, legally separated, or you're in the process of filing, in the process of divorce. So the last 6 months, you've not been staying together. So what do? You say, okay, I'm single, but at the same time, for more than half of the year, I'm maintaining my house, which is a principal residence of, okay, I will not say a qualifying child. Let's me call this a dependent child. Okay, let me call it a dependent child. Okay, so I am single or I'm legally separated or I'm in the process of getting separated. And for more than half of the taxable year, I have a dependent child who is living with me. Okay, so the child may be my child, stepchild, legally adopted child. Here it includes foster child. So this is one thing I want you to register. A qualifying surviving spouse cannot include a foster child, but in case of an HOH, you have a foster child included. It will also include brother, sister, or their descendants. So the definition of child is a little wide in the US. So be careful about it. You need to have a mother or a father, but they have done away with the requirement of your parents staying with you. Okay, so let's assume there is a couple in the US. The father or the mother stays away from them, or let's say they are staying in a nursing home, and at the same time, you are paying for the upkeep. So you are the one who's paying for the money in the nursing home. So you are providing for them, and that is why they are dependent on you. So the requirement that the parents have to stay with you in order to qualify as a HOH is not there. And remember, it is only for a parent, right? You may have somebody who's ill and who's, again, there's a movie, very nice movie that came to my mind, but I forgot the name. Ryan, what was it? It's a notebook. I think that's the name of the movie, right, guys? So in the end, you will see that there's a lady who's staying in the nursing home, and the family is going and meeting her every day, right? So if that situation happens, one person is really ill, staying in the nursing home, but you are providing for that person, and for more than half of the tax year, for the entire year, your home is the principal rest. So remember, it's not more than half of the tax year; it is the entire year. Your house is the principal residence of that parent. So just because that parent is not staying with you, will not prohibit you, will not prevent you from filing as a HOH status. So the dependent child has to live with you. Parents need not stay with you. Please remember relatives. So HOH is only applicable for relations, not for friends. Remember that. Okay. So I moved to the US. I have a very close friend of mine. That person shifts with me, and let's say that person is studying CPA with me. Can I claim? So I am maintaining so my house is her house. I'm paying for her education and all of that. If she is related to me, yes, I get a HOH status. If she is not related to me, we're just friends, I cannot take the HOH status. So remember, relatives, uh, not friends. Okay, this HOH is not applicable for friends. If there's a relative, this relative must stay with you in order to get you an HOH status. Remember, it will not include foster parents, it will not include cousins, it will not include unrelated dependents, somebody who is related to you. Okay, so imagine if one person is staying in the US earning, wants to get married. Marriage has not yet happened. The spouse moves, starts staying with that person and study. Can you get a HOH status? The answer is no. You cannot get an HOH status if you're living together if that person is not related to you. If that person is related to you in any way, and then if that person is staying together with you, you do get an HOH status. So, two things I want you to remember. Qualifying surviving spouse is for the full year. You've got to maintain a house, which is a principal residence of a dependent child. For an HOH status, it's not applicable for non-resident aliens. It does include foster children also, but you need to have a single or a divorced or a about to be divorced status. And you must maintain a house which for more than half of the tax year must be the principal residence of a dependent child who has to stay with you, for a father or a mother who need not stay with you, for a relative who has to stay with you. It is not applicable for anybody who is not. Okay, when I say I'm maintaining a house, what do you mean by maintaining a house? I mean, so I'm saying I'm maintaining a house which for more than half of the year is a principal residence of a child who's staying with me. Maintaining means I'm paying the property tax, mortgage, rent, utilities, upkeep, repair, all of these for that house. It does not mean I'm paying for that person's clothes. So this is support, guys. This is support. You are going to use this when you're going to define a qualifying relative. But you're not going to use this in order to say that you're maintaining a home. Maintaining a home means spending on the house. Providing somebody a support means providing that person clothing and education and transportation and vacation and stuff. So we're not talking about support. We're talking about maintaining a house. Okay? Okay. Again, this is a little premature. You're going to read it a little later. Um, in the US, if somebody is divorced, which is, and I think it's a little more common in the US than it is in India. I have a sister, and I remember 3 years back, now her son is around 13 and a half. I'm talking about at least 5, 6 years back. The moment there used to be a heated argument between Didi and her spouse, her son would come up and say, "Okay, are you going to get divorced?" So that concept is a little bit more common in the US than it is that is in the Indian parlance. Even now, I've never heard my son coming and asking me, "Are you and Papa going to get divorced?" No, but in the US, it's a little more common, and I think that's how it's going to be for most developed economies. Okay, now what happens is if the parents are divorced, who gets to claim the child as a dependent? So then the rules are very simple. Again, these rules have changed, guys. Earlier it used to be something else, but today the rules are very simple. Whoever has a greater custody of the child will get to claim the child as a dependent. It means it does not matter who is paying for the child's education, who is paying for the child. So it doesn't matter how much support is being given to the child by whom. What is important is who is staying with the child for a greater number of days. So that parent who's staying with the child for a greater number of days is called a custodial parent. So we say whoever has the custody of the child for a greater part of the year, remember it's custody, not support. So one spouse may be earning and just funding for the education and stuff. But no, I'm not going to let you claim that person as a dependent. The dependency status will be claimed by somebody who is taking care of the child and has the physical custody of the child for a greater part of the year. So in case if a person who has the custody willingly signs a form and says, I don't want to claim that person as a dependent, then there's a form. See, a custodial parent who has released the right to claim the dependency exemption to the non-custodial parent by filing a particular form may still qualify the HOH status. See, I may not be claiming that person as my dependent. Okay, I want somebody else to do that. But I can still claim my status as HOH and pay lower taxes because it was my right to claim that child as a dependent whom I have forgiven and given it to my spouse, erstwhile spouse. But I can still get an HOH status. But the reverse is not true. I cannot file a 8332 and say, okay, see, I'm a non-custodial parent. Now I filed this form. Now I want to claim myself as an HOH. No. An HOH status can only be claimed by a parent who is a custodial parent. Period. Now, whether that parent would continue to be treating that person as a dependent is a choice that the parent has to exercise. If they don't want it, they can file up a form and they can relinquish that right. But the HOH status cannot go to the parent who is a non-custodial parent. Okay. Now this is important, guys, because you will see that earlier, like I'm talking about 5, 6, 7 years back, whenever I used to teach this, at that point of time, it used to be like whoever is the higher earning parent, that parent gets to keep the child or claim that child as a dependent. Now they have segregated the earning and the support from custody totally, and they are giving more weightage to the custody than the support. Okay. So any answer choice that talks about custody, that talks about support, in preference to custody, you have to be clear about it. The first one, for each, sorry, for each of the independent situations provided in the table below, you're supposed to qualify let me know what's the qualifying filing status for the person. If anybody is married, you're going to assume that they're going to file a joint tax return. Okay. And then the status. Okay. A and B married on 30th of December of the current year. A had taxable wages of $50,000 in the current year. B was unemployed, did not have any taxable income, and they do not have any children. What is their filing status? What is their filing status? Please clear about this. The filing status is going to be married, filing jointly. Yes, you're correct that. Okay. C and D became engaged in January of the current year. They lived together for the entire year and then got married on January 2 of the next year. C and D each had taxable wages of 50,000 during the current year and they do not have children or other dependents. On 31st of December of the current year, are they married? Are they not married? They are not married. If they are not married, it will be single.
Correct, yeah.
Third, he is unmarried and provides most of the support for his elderly aunt. He paid more than half of the costs of his aunt's nursing home, where she lived the entire year. His aunt did not have any taxable income in the current year. any taxable income in the current year. So what they're trying to tell you is that yes, I'm providing more than half of the support of my aunt who is not staying with me. I'm providing more than half of the support of the aunt. Now see, the way you should think of it is like this. Can it be single? Maybe. Can it be married filing jointly? No. Obviously no. Can it be QSS? Obviously no. So the choice is HOH or single. Now for HOH, what is the condition? For HOH, the condition is if it's a relative, the relative has to stay with you for the entire year. If it's a relative, they have to stay with you for the entire year. The exemption is provided only for parents. Is this clear enough? Okay. So the answer becomes single. HOH is the next one. F is unmarried, provides most of the support for her elderly father. F paid more than half of the cost of maintaining her father's house where he lived the entire year. And there was no taxable income for the father. See here, guys, only because it's a father, I give them that leeway that they need not stay with me. So if you recall, if you take 3 versus 4, see the only difference is both of them were dependents. But the only delta is for a parent, it's okay if they're not staying with me. But for a relative, they have to stay with you for the entire year. 3 and 4, is this clear? So this becomes head of household. Is it clear? Fifth one now. G spouse H died in January of the current year. They don't have any children, they don't have any dependent. What is the marital status? What is the filing status? 5 and then the number. So it is married filing jointly. So please, the moment they say death, don't get excited. Relative, dependent. No. Death, the year of death, only if the remarriage has to happen. Then it might be a different scenario. If there's no remarriage, then it's married filing jointly. Okay, that was the fifth one. Okay, the sixth one now, right? I spouse J died last year. So last year there was a death of the spouse. So I should be very alert. I can be single. I can be QSS also, right? J and I do not have children. The moment they say J and I do not have any children, that means QSS cannot happen, right? I paid more than half of the cost of her mother's nursing home, where her mother lived the entire year, and the mother did not have any taxable income. So what's the filing status? So this is, can you see, this is like a distractor. J died last year, nothing to do. J died last year, the child is not there. Cannot be QSS. Now it's either single or HOH. Can it be HOH? The answer is yes. You are providing more than half of the cost of the house, and the parent need not stay with you. Yes, so I can be an HOH. One. K spouse L died 5 years ago. L and K do not have children or other dependents. This is easy. Everybody single. Okay. M spouse N died in May of the current year, and M provided all of the support for the 7-year-old daughter who lived in M's home the entire year. Everybody? Year of death, MFJ. 2 subsequent years, maybe QSS if there is a dependent child for whom you have maintained the house for the whole year. Is it clear? Okay. Next. O spouse P died last year. O provided all the support for their 15-year-old son who lived in O's home for the entire year. Bingo. Now we have the next status. What is the status now? Everybody, is this clear? Last year, the spouse died. This year, I have a child who's dependent on me, and I'm maintaining a house for the entire year for that child. So I can call myself. So Q spouse R died 5 years ago. Q paid most of the cost of maintaining a home where her 17-year-old daughter lived until May of the current year, when her daughter went to live with her grandmother. What is the status? Thank you. The next one. S and his spouse divorced in December of the current year. S's 12-year-old son lived with his mother during the school year and lived with S in summer. So that means S is a non-custodial parent, right? S provided most of their son's support. I am a non-custodial parent providing more than or most of my son's support who's not staying with me. What is my status, guys? What is my status? 11. I'm a non-custodial parent. Doesn't matter how much support I'm giving to the child. I'm a non-custodial parent and I'm legally divorced. My status is single. Is this clear? This is important. So be careful about this. My status is single. He and her spouse divorced in January of the current year. So this year you're legally separated. His 9-year-old daughter lived with her during the school year and lived with her father in summer. So basically now it is the other side of the same story. So you can say S and T were married, they got divorced in the current year. The daughter is going to stay with with T and go to the father in the summers. And the father is providing most of the support. What is the status of the mother now, guys? HOH. Is this clear? So we have covered the entire concept of custodial, non-custodial parent, the concept of HOH versus single, the concept of MFJ versus qualifying surviving spouse. Now look at the next one. You and his spouse, me, filed for divorce in November of the current year. They lived apart, but they did not obtain a legal separation. So go back to that chart. Are you legally married? Yes. Are you legally separated? No. The divorce was not finalized until Feb. They do not have any children or other dependents. What's the filing status, guys? Married, filing jointly. Somehow I find regulation as a very good paper for, understanding if you can visualize the flow charts in your mind. It is crisp. See, one very good thing about regulation is there is no gray area in regulation, guys. It's pure black, pure white. So you would exactly know when you're getting your answers correct. Okay. W is unmarried, provided most of the support for his 3-year-old grandson who lived in W's home the entire year. The entire year. Yes, guys? HOH. Now see, it's coming easily, right? Everybody. Child includes son's child, grandchild, the same lineage. It includes that, okay? X is unmarried, provided most of the support for his 25-year-old girlfriend who lived in X's home for the entire year. So there is. So see, MFJ, QSS, MFS, not possible. Single HOH. HOH, not applicable for a non-relative. HOH, not applicable for a non-relative. So the only possible choice is single. So this is a very good case, guys, okay? HOH is not applicable for a non-relative. Y and her spouse married 3 years ago. In October of the current year, they moved into separate homes. They obtained legal separation in November. They do not have any children. What's the status? What is the status? They are married, but now they are legally separated. So now you are single. Is it clear? The last question. Z and his spouse divorced 3 years ago. Z obtained most of the support for his 20-year-old daughter, who's a full-time college student for the current year. The daughter lived in the college dorm during the academic year, but lived with Z in summer. She did not have any taxable income in the current year. What is the filing status for Z? So it doesn't matter for education purposes if somebody is going and staying in the hostel, that's still okay. It will not prevent you from taking the HOH status. Is it okay? Now there's a very good challenge question, okay? And I want to see how many of you are able to crack this question, okay? Married? A, B married? A died. B remarries. Tell me what would be A's filing status? A is going to file the last return, right, guys? There will be a last return that has to be filed for A. A and B are married. A died. B went and remarried. What will be the filing status for A? Who files? Yeah, so there is a progeny. So there would be somebody who would be entitled to file that return. Status. That's the only time when the IRS can force you to file a married filing separately return. Yes, this is the only place where IRS, because see, somebody exercise the discretion, right? I can't go and stop B from remarrying. But if B remarries, then the person who's no longer there will have to file a married filing separately return. This is the only situation where an MFS can